Interest rates have gone up, but have cap rates gone up? Let's talk about that, the relationship between interest rates and cap rates today as we explore your self-storage business. Hello, my name's Mark Helm, and I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Self-Storage Quick Start Academy. And what I do is I support the small investor who wants to get in the self-storage business or who wants to grow their self-storage business in a strategic way that creates true wealth and a fulfilling career. And to support the small investor, I have lots of training, both free and in-depth paid for, at quickstartacademy.com. And it supports you, the small investor who wants to get in this fantastic business of self-storage. And prices have been high for the past 5 years or so, right? And when we started to have this interest rate increase, I thought that cap rates would soon start rising too and values would reduce. I've been told through all my real estate training that cap rates follow interest rates. Now, as we move into the hypersupply phase of the real estate cycle, typically what happens to help reduce development, the Fed will often start raising interest rates. If I recall correctly, our first interest rate increase was in December 2015. Usually, or what I was told would happen, is cap rates would follow. I haven't seen that happen, have you? So if you're not sure what I'm talking about when I talk about real estate cycles, go to last week's episode. If you're not clear what I'm talking about when I'm talking about cap rates, go to episode 127, and we talk about a good way for the small investor to relate to a cap rate. However, what I've seen is that as interest rates go up, I don't see a direct correlation between cap rates going up along with interest rates. I did a lot of research, found a number of charts. Here's a couple of examples of some charts that I saw. What I see is there may be a loose connection, but I don't see a direct lockstep correlation between interest rates going up and cap rates going up. Fears that as interest rates go up, cap rates will go up and the value of your self-storage facility will go down. Well, it's a double-edged sword. What that means is what you own, the value may go down, but what you want to buy may be a lot easier to purchase and put into service. But I didn't see the direct correlation between cap rates and interest rates. Now, I'm not an expert, I'm not the sharpest tool in the shed, but as a business owner, I'm trying to look out into the future and make decisions today based on where I see our portfolio and where I see the industry going. Now, the reality is, we have no control over the interest rates, and we have no control over the cap rates. What do we have control over? We have control over what the net operating income is, the NOI of our facilities. So what my suggestion is, as business owners, don't focus on cap rates, don't even necessarily focus on interest rates, focus on your NOI. That's what you have control over as a business owner. Now, as interest rates go up, what happens is that can affect the net operating income. More importantly, it can affect the distributable cash you have below the net operating income, but higher interest rates can have an impact on your net operating income, but not much of one. What does have an impact on your net operating income? Well, since 2016, I've noticed that there's been more pressure on our NOIs than the previous 3 to 4 years earlier. And in this order, this is what I'm seeing is putting pressure at least on our net operating incomes. One is property taxes. For some reason, across the country, self-storage has caught the eye of the property valuation people, and in almost every market we're in, we're getting property tax increases. The next is marketing costs. As we move into the hyper supply or oversupply phase of the economic cycle, market by market, what happens is we end up spending more money on marketing and advertising to get customers in the door than we previously had. And the final thing is the lease concessions, having to discount and offer concessions to get new tenants to sign the leases. Those are what we're seeing having an impact on our NOI, not necessarily interest rates going up. Now, as interest rates go up, that does mean there's less distributable cash if your loan is tied into that. And more importantly, when it comes time to refinance your note, it could be a double whammy. What happens is, as interest rates go up and there's pressure against your NOI, it makes the underwriting of the new loan more challenging. And if cap rates do go up, what that means is that the value of your asset may go down from what it was worth a few years earlier. Now, here's what I see has more of an impact on cap rates than anything else, and that's the fundamentals of the industry. In other words, market by market. What is the supply demand in your market area? Are your occupancy rates holding steady, or are you experiencing declining occupancy rates and higher vacancy rates? Is there a lot of discretionary spending in your market? What is the per capita of self-storage, square feet of self-storage per person? Those are what, in my opinion, I see impacting the cap rates way more than the interest rates. And as savvy investors, and even though we're small investors, we can be savvy investors, as we keep our eye on that, that's what at least I monitor to have a relationship with the capitalization rates and the value of our assets. Our job as self-storage owners and operators is to mitigate the impact of the lower occupancy rates on our net operating income. If we can keep that NOI up as much as possible, that is what's going to have a big effect on the value of our assets. And that is something that is within our control as business owners. So how does that look on the court? Well, for one, it looks like hiring a professional to appeal your taxes as get your property tax increases. We have professionals all over the country that we hire that will appeal the taxes, and typically we don't have to pay them unless they're successful. Then we usually pay them a percentage based on the amount of taxes that they save us. What else does it look like on the court? Well, it looks like you will be monitoring the rental rates in your sub-markets like a hawk and know exactly where you are in relationship to the sub-market and what your product is in that sub-market. And if there's any opportunity for price increases, you will do them, and you will do them immediately to keep the NOI as high as possible. It looks like as you're underwriting your projects to put in service, even though they're over 90% or 93%, you underwrite them at 85%. Why? Because you know that when we go into a recession period or when we go into hyper supply, your occupancy rates will drop. So you underwrite them to compensate for that drop. It might look like on the court that you use alternative pricing strategies like value-added pricing. If you're not sure what I'm talking about, go to episode 154. It might look like that you employ the use of a kiosk more. Even if you're a large facility like we are, we own facilities that are over 50,000 square feet, we now will use a kiosk in off-peak times where we used to use employees. It might look like on the court, as you underwrite your projects and you're doing expansion or new construction, you use a lower absorption rate or rent-up rate than you used to, or even what's in the feasibility report. And it definitely looks like before you start a new project, you know the supply, demand, and all of the pertinent numbers in the submarket that you're looking at. The beauty of self-storage is that no matter where we are in an economic cycle, every one of those create demand for our product. Typically, our customers are people who are in transitions, and every single phase, expansion and recession, generate transitions for people, and that's when people need our product. It was during the last recession that our product showed up on the map and started attracting all the investment capital that you see going into it. Our job is just to know what's coming next and to take appropriate actions at every given phase of the economic cycle so that we're maximizing the return and the value of our asset. So when I'm in conversations and I hear the pundits on the radio or television, or I'm talking to other people and they're having conversations about cap rates going up with interest rates, I typically will nod and smile and not say much, because I know I'm putting my attention on what I can have an impact on, and that is keeping the net operating income as high as possible. You do that. It doesn't matter where you are in the economic cycle. If you're doing that with self-storage, you will create true wealth and a fulfilling career. Next week, we're going to look at how this product, self-storage, actually performs during recessions. So I can't wait to be with you. Thank you very much. And if you're not using the Storage World Analyzer, I invite you to go take a look at it. This is what we use to underwrite our storage facilities and opportunities that we're looking at before we put them into service. When I'm talking about underwriting at 85% occupancy, or I'm talking about going with a lower lease up or absorption phase, this is all what we put into the Storage World Analyzer so that we can project fairly accurately what our future cash flows are going to be, and that informs us what we can pay today for those future cash flows. So if you're not using it, I invite you to go take a look at it. StorageWorldAnalyzer.com, or you can go to the home website, CreatingWealth through Self-Storage.com, where all this training is housed. So thank you very much. I look forward to being with you again next week.